If you're looking for a single ETF to invest in the global stock market, you'd probably expect the choice to be pretty straightforward. After all, how complicated can it be to invest in the entire world? But once you start looking at global ETFs, you quickly run into a problem. You might come across the FTSE Global All Cap, the FTSE All-World, the MSCI World, the MSCI ACWI, and the MSCI ACWI IMI. 5 different indexes, all with names that sound like they're doing pretty much the same thing. So what's actually the difference? And more importantly, does it really matter which one your ETF tracks? Well, the good news is that understanding these 5 indexes is actually much easier than it first appears. Because although there are 5 different indexes, the differences between them can largely be explained by answering just 2 questions. Which markets are included, and which companies are included? Once we understand those 2 questions, the 5 indexes start to make a lot more sense. So in this video, we're going to break down exactly what these 5 global indexes are, how they differ, and why those differences matter if you're investing through ETFs. And this is actually the first video in a new series here on Effortless Investor. Having established how these 5 indexes work, I'll then take each one individually and compare the ETFs available to investors, ultimately ranking them to see which ones offer the best overall proposition. But before we get into the 5 indexes themselves, we first need to understand what a global index actually is, and the 2 simple questions that determine what goes into one. At its most basic level, an index is simply a set of rules that determines which companies are included in a portfolio. And when it comes to global indexes, there are 2 important questions those rules need to answer. The first is which markets should be included, and the second is which companies within those markets should be included. Let's start with the markets. When you hear the terms developed market and emerging market, we're essentially talking about different stages of economic and financial market development. Developed markets are countries with relatively mature economies and financial markets. They tend to have established stock exchanges, well-developed financial systems, strong regulatory frameworks, and a large number of publicly traded companies. Countries such as the United States, the UK, Japan, Canada, France, and Germany are all examples of developed markets. Emerging markets, on the other hand, are economies and financial markets that are still developing. They can offer strong economic growth and increasingly sophisticated financial markets, but they come with greater political, economic, and currency risks, as well as less mature financial systems. Countries such as China, India, Brazil, and South Africa are examples of emerging markets. Now, the important point here is that global doesn't necessarily mean every country in the world. An index provider has to decide which countries and markets are developed enough, accessible enough, and investable enough to be included. And different index providers can use slightly different criteria when making those decisions. So that's our first question: which markets are included? But that's only half the story, because even once we've decided which countries we're investing in, we still need to decide which companies within those countries we're going to own. And this brings us to the second question. Companies are often categorized according to their market capitalization, or simply their market cap. Market capitalization is the total value of a company's outstanding shares. And broadly speaking, companies can be divided into 3 groups. Large cap. Now these are the biggest publicly traded companies in the market. Think of the huge multinational businesses that most investors will already be familiar with. Then we have mid-cap. These are the medium-sized companies, smaller than the giants of the market, but still substantial businesses in their own right. And finally, small cap. These are the small, publicly traded companies which can include businesses that are still growing and have the potential to become much larger in the future. So you might reasonably ask, why wouldn't a global index just include all of them? Well, in theory, it could, but there are some practical reasons why an index provider might choose not to. Firstly, the smaller the company, the less significant it generally is in terms of total market capitalization. If you're trying to represent an overall global stock market, including every small company can add a huge number of additional holdings while making a relatively small difference to the overall value of the portfolio. There are also practical considerations around liquidity, investability, and the cost of buying and selling very small companies. So index providers have to make choices about how broad an index should be. And this is where our two questions come together. A global index has to decide whether to include developed markets, emerging markets, or both, and whether to include large cap, large and mid cap, or large, mid, and small cap. And once those decisions have been made, you end up with a very different definition of what the global stock market actually means. Now that we understand these two dimensions, we can finally look at the 5 major global indexes and see exactly how each one answers those two questions. And we'll start with what is arguably the broadest of the 5, the FTSE Global All Cap. And as the name suggests, FTSE Global All Cap is designed to provide broad exposure to global equity markets across both developed and emerging markets. And importantly, it doesn't just focus on the largest companies. It also includes large cap, mid cap, and small cap companies. And that's what gives FTSE Global All Cap its particularly broad coverage. But there's an important point to make here. When we say that an index includes small cap companies, that doesn't mean that small companies suddenly make up a huge proportion of the portfolio. Remember, these indexes are generally weighted by market capitalization. So the largest companies still dominate the index, while small cap companies make up a much smaller proportion of the overall portfolio. We'll come back later to why that matters, but for now, let's move on to the next index. FTSE All-World takes a very similar approach when it comes to geographic coverage. It includes both developed and emerging markets, but there's one important difference. FTSE All-World focuses on large and mid-cap and does not include small-cap companies. So if we compare it with the FTSE Global All Cap, the key difference is simply the bottom end of the market. And that's our first example of how two indexes can both provide broad global exposure but still have different definition of what constitutes the global stock market. Now let's move on to an index with a name that can be slightly misleading. At first glance, you might assume that an index called MSCI World represents the entire world, but it doesn't. MSCI World covers developed markets but does not include emerging markets. And when it comes to company size, it covers large and mid-cap companies but not small caps. And this is an important distinction to understand. MSCI World is a global index in the sense that it covers a large number of countries across the world, but it isn't a complete representation of all global equity markets because emerging markets are excluded. Next up is the MSCI ACWI index, and ACWI stands for the All Country World Index. And that name gives us a pretty good clue about what it does differently from the MSCI World. MSCI ACWI includes both developed and emerging markets. So unlike MSCI World, emerging markets are included. However, just like the MSCI World, it focuses on large and mid-cap companies. At this point, you might notice that MSCI ACWI and the FTSE All-World have a lot in common, and you'd be right. Both provide exposure to developed and emerging markets and both focus on large and mid-cap companies. But they're not identical indexes. They are created by different index providers, use their own methodologies, and can differ in exactly which countries and companies qualify for inclusion. So even when two indexes appear to be doing essentially the same thing, there can still be some differences under the surface. And finally, we have the fifth index, which is the MSCI ACWI IMI index, with the IMI standing for Investable Market Index. And this is where we return to our original two questions. MSCI ACWI IMI includes both developed and emerging markets, but unlike the MSCI ACWI, it also extends its coverage beyond large and mid-cap companies to include small-cap companies as well. And that means MSCI ACWI, IMI, and the FTSE Global All Cap are both designed to provide very broad coverage of the global equity market, including small companies. So we've now looked at all 5. And if you're thinking that keeping track of all these combinations sounds slightly complicated, don't worry, because we've reached the point where we can put all 5 side by side. And when we do that, the differences become much easier to see. So remember, there are only really 2 questions we need to ask. Which markets are included and which companies are included? And here's how the 5 indexes compare. And when you see them laid out like this, the differences become much easier to understand. There are really only 2 variables changing. The first is whether emerging markets are included or not. MSCI World is the outlier here because it focuses exclusively on developed markets. The other 4 include both developed and emerging markets. The second variable is whether small cap companies are included. FTSE Global All Cap and the MSCI ACWI IMI include large, mid, and small cap companies. The other 3 focus on large and mid cap companies only. So despite having 5 different names, these indexes are really just different combinations of the same 2 decisions. And that's why I think these 2 questions are worth remembering. Developed or emerging? And large and mid, or large, mid, and small? Once you know the answer to those 2 questions, you can understand the basic structure of any of these 5 indexes. But there's something else that's really important to understand. Just because 2 indexes have different rules doesn't necessarily mean their actual investment portfolios are going to look dramatically different. And that's where things get a little bit more interesting. So at this point, you might be thinking, if these indexes have different rules, how different are the actual investments? Although there are some genuine differences between these 5 indexes, they can actually end up looking remarkably similar. And the main reason for this comes down to one thing: market capitalization weighting. Most of these global indexes are weighted according to the size of the companies within them. In simple terms, the bigger the company, the larger its weighting in the index. And when you look at the global stock market, the largest companies are absolutely enormous compared with the smaller companies. So even if an index includes thousands of small cap companies, those companies collectively represent a relatively small proportion of the overall market compared with the largest companies. This means that adding small cap companies can make an index broader without necessarily making the overall portfolio look completely different. The same principle applies when we look at emerging markets. Adding emerging markets gives you exposure to a different group of countries and companies, and that certainly matters. But developed markets, particularly the United States, make up a very large proportion of global stock market capitalization. So adding emerging markets doesn't suddenly turn your portfolio into something completely unrecognizable. In fact, if you compared the 5 indexes based purely on their largest holdings, you would probably find a lot of familiar names appearing again and again. The biggest global companies are so large that they tend to feature prominently across most broad global indexes. And this leads to an important point. Broader doesn't necessarily mean dramatically different. An index that includes small cap companies is certainly broader than one that doesn't. And an index that includes emerging markets gives you exposure to more of the world's investable markets than one that excludes them. But the difference in the overall portfolio may be much smaller than the difference in the names of the indexes initially suggests. So should you choose an index that covers the most companies? Well, not necessarily, because we're not simply choosing between 5 indexes in isolation. We're ultimately choosing an ETF that tracks one of these indexes. And that's where things get much more interesting for investors, because the index tells us what the ETF is designed to track, but it doesn't tell us everything we need to know about the ETF itself. And that brings us to the really important question. If these indexes are all giving us broad exposure to the global stock market, which one should we actually choose? For clarity, there isn't necessarily a single best global index, because the answer depends on what you're trying to achieve with your investment. If your priority is to capture as much of the global stock market as possible, you might prefer an index that includes both emerging markets and small cap companies. If you prefer a slightly narrower approach, focusing on the larger companies in developed and emerging markets, That's also a perfectly reasonable choice. And then there's nothing inherently wrong with choosing an index that doesn't include every possible market or every possible company. The important thing is understanding what you're actually buying. And this is where we need to make an important distinction. An index isn't an ETF. An index is essentially a set of rules. It tells us which companies should be included, how they're weighted, and when the index should be rebalanced or reconstituted. An ETF, on the other hand, is the investment vehicle that you actually buy. And the ETF provider's job is to track that index as closely as possible. So two ETFs can track completely different indexes, but equally, two different ETFs can track very similar indexes and still offer quite different propositions to investors. Because once we move from the index to the ETF, we have a whole new set of things to consider. How much does it cost? How closely does it actually track its index? How large is the fund? How liquid is it? Where is it domiciled? Is it accumulating or distributing? How is it structured? And are there any other characteristics that could make one ETF more attractive than the other? So when we're choosing a global ETF, there are really two decisions being made. The first is, which index do I want my ETF to track? And the second is, which ETF is the best way to access that index? And that's an important distinction, because finding an ETF that tracks a suitable global index is only the first step. The next question is whether you've found the best ETF available for that particular index. And that's exactly what we're going to look at in the rest of this series. I'm going to take each of these 5 indexes individually and look at the ETFs available to investors that track them. We'll start with the FTSE Global All Cap, then move to the FTSE All-World, MSCI World, MSCI ACWI, and finally the MSCI ACWI IMI index. And for each of these indexes, I'll be comparing the available ETFs using the same criteria. We'll look at things like cost, tracking difference, fund size, liquidity, structure, domicile, and whether the ETF is accumulating or distributing. The aim isn't simply to find the ETF with the lowest fee, because the cheapest ETF isn't necessarily the best. Instead, we'll look at the overall proposition and try to answer a much more useful question. Which ETF gives investors the best way to access this particular global index? And by the end of the series, we'll have 5 individual rankings, one for each of the 5 indexes we've looked at today. So if you're trying to decide which global ETF might be right for you, this series should give you everything you need to make a much more informed decision. So in the next video, we'll start with the FTSE Global All Cap and find out which ETF comes out on top. Make sure you subscribe so you don't miss out, and I'll see you in the next video.